Management of working capital. This is chapter 10 of Financial Management and Economics for Finance, CA Intermediate Paper 8. Okay, this chapter is divided into 6 units and we will study unit by unit. First, let us start with Introduction to Working Capital. Thereafter, we will move to other units. As I said, the chapter has been divided into 6 units and the first unit is Introduction to Working Capital Management. In accounting term, working capital means it is the difference between current assets and current liabilities. That is, working capital is equal to current assets less current liabilities. And let us understand what are current assets and what are current liabilities. Current assets. It is expected to realize or intends to be sold or consumed in normal operating cycle of the entity. See, realize, that means we will be able to encash. Realize means we will be able to encash. Or intends to be sold, that means we are trading, doing the trade. That is, we are selling the goods. Or consumed, that means we will be using in our daily manufacturing process in normal operating cycle of the entity. So any asset which is expected to realize or intends to be sold or consumed in normal operating cycle. See, every business will have some operating cycle, say from raw materials to finished products and finished products to sales, and from sales to debtors and debtors to realization. So if any asset is falling under this process, then it can be said as current asset. And next is, the asset is primarily held for the purpose of trading, because as I said, it is held for trading. That means we are doing business with that asset. We are not buying the asset or we are not manufacturing the asset for the purpose of use in our business. It is manufactured for the purpose of sale. Okay, we purchase materials, we manufacture the product and sell it, or we buy the product and we sell it. Okay, so the asset should have been primarily held for purpose of trading. Then it is called current asset. Then it is expected to be realized within 12 months after reporting period. So whatever the asset we have procured or whatever the raw material we have purchased, we are expecting that it will be realized within 12 months after the reporting period. Usually the reporting period, for example, is 31st March of every year. So before 31st March of next year, if we are expecting that it will be realized, it will be sold or it will be consumed, then it is called current asset. And it is non-restricted cash or cash equivalent. That means there is no restriction. I will not be able to sell, I will not be able to realize this. There is no such restriction on that particular asset. Then it is called current asset. Okay. Now let us understand what are current liabilities. Similarly, it is expected to be settled in normal operating cycle of the entity. Like how we said the trade receivables or materials can be realized. Here that can be settled. That means I procure material on credit from suppliers and I pay them, say 30 days time period or 60 days time period. Okay, it will be settled within operating cycle of the business. Okay, next, the liability is primarily held for the purpose of trading. Again, it is the liability which is created because I have to manufacture or I have to do business from the materials or products which I procured from my supplier. Then that liability is called current liability. It is expected to be settled within 12 months after reporting period. See, no creditor will give credit for more than 12 months. Okay. So from the date of reporting, if any liability is expected to be paid, okay, then it has to be treated as current liability, and all those liabilities will be considered under current liabilities while calculating the working capital. The concept of working capital can be explained in two ways. One is on the basis of value and another one is on the basis of time. Say, on the basis of value, gross and net. What is gross working capital? Gross working capital means the amount which is invested by an entity in current assets is called gross working capital, total value. And what is net working capital is what the difference between current assets and current liabilities is net working capital. And on the basis of time, it is permanent and one is fluctuating. Why permanent and fluctuating? Because for any product, the demand will not be same throughout the year. It may be fluctuating depending upon the seasons, depending upon the market requirements. So there will be certain permanent working capital and certain fluctuating working capital. So the permanent and fluctuating is explained below graph, where permanent is a straight line. It may be straight line, horizontal line towards the time, or it may be elevated line towards against the time. Okay, why elevated line? Because the demand in various seasons may be different in different periods. Though it is stagnant, but it is in numbers or more over the period of time. Here the line can be in any way. At the beginning of the year it may be more, and then it come down less, okay, but it can be, need not be like here straight, which is a very horizontal or parallel to time. It can be elevated line also. Let us understand what is the significance of working capital. It is the responsibility of the finance manager to ensure that there is adequate working capital in the system. And this working capital should not be neither too huge or too small. Reason being, if the working capital is more than adequate or optimum level, then it means the funds are lying idle. Same way, it should not be very less, where we will not be able to meet our demand. Next, large amount of working capital means that a firm has idle funds. Excess funds in working capital has the opportunity cost. Suppose if I block huge funds in my working capital, then what will happen is my funds are blocked and I will not be able to utilize the funds, and there is a opportunity cost. Suppose if I have not invested here, I would have invested somewhere else and I would have earned some return on that investment. That is the reason it should not be more than what is adequate. And inadequate working capital means that the firm is not able to service its suppliers within the due dates. Suppose if I don't have sufficient working capital, then I will not be able to pay my suppliers, and then the suppliers will, in future, they will increase the price or they will not give me any discounts. That will have an impact, and this leads to disturbance in supply chain. So what will happen is I will not get raw material from my supplier, then I will not be able to supply to my customers my orders, then there will be disturbance in the business. And once business is affected, then there is a severe problem. Your day-to-day operations are affected, then your profitability is affected, then your returns are affected, then shareholders will get quit, and there will be problem of insolvency also. So it is very important to have adequate working capital, and it is a continuous process. It is not that today in the beginning of the year I plan something and I forget about it. It is every day. Every day we have to keep on monitoring it, and depending upon the changes in the demand supply, we should keep taking right decisions at right time to ensure that the supply chain is properly maintained. Now, what is optimum level of working capital? We say adequate, then what is optimum level? So, with the with various studies, it has been decided that current ratio should be not less than 2. That is current assets to current ratio, current assets to current liabilities should be 2:1, and quick ratio, that is quick assets used to current liabilities, should not be less than 1. In that case, we can say that it is optimum working capital. Determinants of working capital. Working capital management is concerned with two aspects. One is maintaining adequate working capital, another one is financing of working capital. If adequate working capital is not maintained, then what will happen? We will not be able to pay off our creditors, suppliers. Then suppliers will not supply goods, raw materials to us, and then we will have shortage of material to service our customers. Hence, adequate working capital is more important. How this adequacy of working capital can be managed is how we have to manage how this working capital can be financed. What are the ways which helps us in financing our working capital? First is cash to meet day-to-day expenses. Okay, this cash will be required for us to meet our daily labor or daily cash requirement of small materials. Okay, next, inventory. Identify the optimum level of inventory. We have to identify what is our optimum. There will be various components of the inventory depending upon the entity. Okay, we have to see which raw material is required more and which raw material is required less, which raw material is required moderately. Then what is its minimum requirement for to meet my customers supplies. Okay, then we have to see just in time materials. So there may be certain materials where if I place the order, immediately the raw material comes to my factory. Then I need not invest much in that kind of raw materials, and there will be some lag time in supplying the materials. Okay, in that case, what we have to do, we have to plan our procurement, place the order, and we have to see that the material is rightly available for us to utilize in the business. And next, receivables. Coming to receivables, receivable also plays very important aspect in financing the working capital. See, what will happen if I don't sell the goods on credit? Then my sales, I cannot improve my sales. So if I have to improve my sales, I have to sell goods on credit. Okay, in that case, I have to invest certain money in my receivables also, and there should be proper credit policy that my customers have to pay within 10 days, 15 days, or there are certain businesses like restaurant and all, you need not give any credit. Okay, it is cash sales. So depending upon the business, we have to have proper credit policy to ensure that the money is realized appropriately and there is no delay in collections which affects my overall working capital. Okay, and short-term financing options. Short-term financing options means this cycle converting this raw material to finished goods to receivables, and from receivables to cash. Okay, in that case, if there is any delay in receivables, we can also pitch in factoring agencies where they will help us in collecting our realizing our debtors, or they will buy my trade receivables and they will pay upfront. Okay, what is the cost of that particular activity, that we have to see, and see if it is interest. If we are able to save on the interest portion, then it is good that we go for factoring the trade receivable and realize the debtors quickly. And nature of business, like I said, cash basis or credit basis. There are certain industries which do business only on cash basis, and there are certain industry where it is done on credit basis. If it is cash basis, then the working capital requirement is it is nil, and if it is credit basis, then depending upon the credit policy, the requirement of the working capital increase or decrease, and market and demand condition. So if there is a good market for the product, then my working capital is negligible because I am able to realize very quickly. I need not stock the materials. Okay, I manufacture immediately, it is sold, I realize it. But in case of where demand is slow, then I have to stock the material. Then what will happen? There is an investment in the finished goods, and so my working capital requirement is high. Okay. Next, technology and manufacturing policies. Similarly, technology and manufacturing processes, because the production throughout the whole year, or instead may choose policy of production only during the demand season. Okay. Depending upon the manufacturing policies also, whether we are producing at the beginning of the, I mean once in a year, and we are selling the product throughout the year, or we are manufacturing throughout the year and selling the product. Accordingly, the working capital requirements will change. And operating efficacy, that is reducing waste and improving coordination. If we reduce the waste, what will happen? My raw material, I am able to use my raw materials effectively, and hence I am able to produce more, the output is more. Then my investment in raw material, I mean investment in product, is less, and if I don't do it efficiently, then my investment will be more. And price level changes. Rising prices necessitate the use of more funds. If the prices are increasing, then I have to invest more, because my raw material cost also will increase, my labor cost also will increase, so everything will increase. So then my investment in working capital will also increase. All these are the ways through which we get working capital into the business. Working capital management plays an important role in any business entity. It is like a lifeblood for an individual. The scope of working capital management can be broadly grouped under two areas. One is liquidity and profitability, another one is investment and financing. When we say about management, it involves three E's. One is economy in financing, efficacy in utilization, and effectiveness in achieving. Economy in financing. So, as we said, working capital means the difference between current assets minus and current liabilities. So, that is nothing but investment by management in current assets. So, while we are investing money, it should be economical. That is first E, economy in financing. And efficiency in utilization. What is efficiency in utilization? The raw materials are to be utilized in more efficient way, and by reducing the wastage, no idle hours by the on part of the labor. All this helps us in reducing the cost, which in turn helps in proper cash flow in the system. Okay, and third is effectiveness in achieving. Similarly, we have to realize the debtors, and we have to complete the processes to achieve our final objectives within the time. The delay in any stage of manufacturing, for example, will make us spend more money, and that will affect our profitability and also our cash flow, and hence all these three E's have to be properly managed. Now let us understand one of the area which we discussed, that is liquidity and profitability, how we can trade off between these two. See, one side I should have proper liquidity and other side I should have profitability. Okay, so how we can achieve both of them? Let us take various categories of working capital and understand one by one. Components of working capital. One is inventory. Advantages of higher side. Okay, now fewer stock outs increase profitability. See, if I am not stocking more inventory, then I need not have more investment in stock. Then I will be saving on my opportunity cost. Then I will have more profit. At the same time, you should understand what are the advantages of low side and its risks also. Lower inventory requires less capital but endangered stock out and loss of goodwill. Suppose if I say I don't want to invest on more inventory, then I will be not able to deliver to my customer if there is any demand. Then I have to run for the raw material. Sometimes it may not be available. Then I have to cut a sorry figure. So that danger will be there. So we should ensure that we have to manage appropriate stock to meet our customer requirements. So this can be trade-off by following EOQ, economic order quantity, just in time. Okay, what is the economic order quantity? Like that we have to do analysis and we have to ensure that inventory levels so that I will be able to advantages profitability and also liquidity. Next, coming to receivables. In case of receivables, if I have to attract more customers, then I have to give credit. This will increase my revenue. At the same time, if I am doing cash sales, then my liquidity is good. Then I need not worry about liquidity. But if you say only cash sales, then your sales may reduce. That is the disadvantage there. So you should see where you can fit in between these two. Whether you have to give credit or how long you have to give credit, that is called trade-off. Evaluate the credit policy, see what is the credit policy that will appropriately fit to your business and where you can attract more customers and you can get more business so that your cash flows are properly managed and addressed. Next, prepayment of expenses. Prepayment of expenses means if I make payment in advance, if I make payment in advance to my suppliers. Okay, so to fix the prices, for example. So that uncertainty tomorrow, if the market prices may go up, then I have to procure material at higher prices like that. Then I may get into loss in the business. So I may make payment in advance to ensure my price stability. Okay, that is, in that case, you may have to invest more in your current assets. Okay. Then if what is the low side? If you maintain low side liquidity, improves or maintains liquidity. So if you don't do that, then you will have adequate cash in your hand or you need not have more investment, then you will have more liquidity. So while taking this decision, you have to see, suppose if I make payment in advance, what is the price benefit I am getting? So I have to get some discount, cash discount, something like that I have to get. If I am able to get some additional benefit by making advance payments, then it is good. Otherwise, it is not good. So that cost benefit analysis you have to do to decide what is the best method you can follow. Suppose if I am making 1 month advance and I am getting 10% discount, then whether it is profitable, or if I make the payment after 1 month, okay, without discount, what is the cost benefit analysis if I do, and whichever is best suits and whichever is more profitable, that you can decide. And next, coming to cash and cash equivalents. See, cash and cash equivalents means what is the advantages on higher side of higher side. Payables are honored in time, improves the goodwill and helps in getting future discounts. Okay, so if I'm maintaining proper cash and cash equivalents, then I will be able to service my suppliers and I can get more discounts because of my timely payments. Then I will get my cost of production will reduce. Same way, advantages of lower side. If I maintain, cash can be invested in some other investment avenues. So if I don't pay my creditors, suppliers, then I can utilize it somewhere else and I can earn some return. But it may not be the right way of doing, because suppliers may not trust you and then they may not supply goods to you, then you will run into business issues. Okay, that's the reason you have to see what is the due dates and pay the creditors accordingly. That trade-off you have to do, whether you have to pay in time or whether you have to pay after the due date, what is the best option, and accordingly you have to decide how much cash flow you have to maintain for making payments to creditors that will help you in continuing your business in a proper way. And payables and expenses, say similar to cash and cash equivalents, here capital can be used in some other investment avenues. If you are not making payment to your creditors, then you can use it in some other avenues. That is the advantage of having maintaining the higher payables. But at the same time, if payables are honored in time, improves the goodwill and helps in getting future discounts. It is, see, cash and cash equivalents and payables. Here what we are saying is maintain more cash and cash equivalents. Okay, here we are saying maintain less cash and cash equivalents. These are both controversy. So that's the reason what we are seeing here, advantages of maintaining high side and advantages of maintaining low side here. Okay, so these both are same, one and the same. Here we are saying we will maintain higher cash and cash equivalents. Here we are saying we will maintain less and cash equivalents. That means my payables are higher. Okay, when my payables are higher, I have more cash in my hand, then I will invest somewhere and I will earn more income from that investment. And similarly, if I have maintained less payables, then I will get more discounts from my suppliers and I will be able to reduce my cost of production. So evaluate the credit policy and related cost. So what you have to do, suppose if I don't pay him within the time, then what will the discount I will be losing, and whether that much benefit I am able to earn in some other opportunity. That trade-off you have to do and you have to decide. Okay, this is advantage of having higher side, that is inventory, receivables, prepayment of expense, cash and cash equivalents, payables, and advantages of having lower side. That means I will maintain less of these components, and what are the advantages and how we have to trade off between these two so that we will not end up in any trouble in the business, because working capital is the heart of the business. Okay. Now let us understand the trade-off in investment and financing. This is the second area of scope of working capital management. So working capital management policy is a function of two decisions. One is investment in working capital, that is how much to invest and how it can be effectively utilized. And second thing is financing of a working capital, from where this investment can be sourced and how economical it can be sourced. And this investment in working capital can be explained in 5 factors. Okay, one is nature of industry. How much to invest depends upon five following aspects. One is nature of industry. See, in this working capital requirement depends upon the industry also, because certain industries work on cash basis, like you say fuel. So nobody will give you credit for fuel. That is advance payment. Similarly, if you go to a restaurant, okay, again here it is cash basis. And also the another aspect is the industry, like construction industry. If you see construction industry, the duration is long. I will start constructing now, I will complete the construction after 3 years. So here the working capital is more. Okay, again, if it is a residential, if it is a commercial, okay, so like that, it depends upon the industry. It depends upon the basis on which that particular industry is operating, whether it is on cash basis or credit basis. Okay, that, so how much to invest depends upon the nature of industry also, and types of products, what kind of products the business we are into. If it is a consumer goods, requires high level of inventory. Okay, consumer goods will require high level of inventory because the duration is long. Okay, and number of cycle is also long, so you will require more investment in business. So more working capital will be required. If it is a perishable goods, then it is not required because it will be either sold or it has to be sold as fast as possible. So the investment will be less. Okay. Next, manufacturing versus trading versus service. Okay. In case of manufacturing, you have to procure material, you have to manufacture it, you have to sell the finished products. So the investment is in 3 levels, that is raw material, work in progress, and finished products. But in case of trading, you are procuring and selling it. So comparatively to manufacturing, the level of the turnaround time may be less in trading or service. And next is volume of sales. Suppose higher the sales, higher receivables, so higher investment. As we discussed earlier, if we want to sell more, we have to give credit. Then when we give credit, then my investment in working capital also increases. Okay. Next, coming to credit policy. Once you give higher duration, credit duration to the customer, then your investment in debtors is more. So you will have working capital is more. If you are not giving more duration to the debtors, I mean customers, then you need not have, your funds will not be blocked in the trade receivables, and hence you will be able to realize cash early, and your investment in working capital will also be nominal. So these are the 5 aspects which decides how much to invest in working capital. It depends upon the industry in which you are operating, what are the products you are selling, and whether you are a manufacturer or trader or service provider, or what is the volume of sales you are doing. Okay, and what is the credit policy you are maintaining. All these aspects decides how much to invest in working capital. In the present video, we studied what is working capital and what is the scope of working capital management, and what are current assets and what are current liabilities, and how much to invest in working capital, what is the trade-off between profitability and liquidity of working capital. For more videos on this chapter, keep watching my YouTube channel and subscribe. Thank you.